Okay, let's go to quantitative. Let's go to quantitative. I think we are in good shape. This is the second part of the presentation, and we are just we just used less than 1 hour. Quantitative analysis. Let's have an overview according to the CP3P guide. Okay, we already discussed this, no? PSC cost, capex, opex, minus income, other PSC costs plus adjustments. PPP cost, the payments to be made to the private party, other costs and adjustments, maybe value for money. Okay, asterisk means potential controversial issues, including or in addition to the rate of discount. Okay, we will go into a lot of detail later on about this, but some general questions, some basic features. Time horizon. Everybody agrees. I mean, time horizon has to be the same in the two projections. Time horizon equal or similar to the expected for the PPP contract term, included the same contract start date and the same construction term, because it's the same project. This has some nuances that we will discuss later, okay? The common rule is using nominal values. Some countries, exceptionally, they use real values without inflation. And the common rule is incorporating taxes in the costs, okay? Then to be able to reflect the difference later on and to adjust for that difference. That is what we call the neutrality adjustment. And a PPP costs are coming from the PPP financial model. Okay, so it's like a shadow bid model that I will do in commercial viability test, and that will give me, which is the amount that I need to commit as payments to this guy. That is my cost. Same project in both cases should be considered, same technical requirements. So base costs are going to be the same. There could be some exceptions like pre-investment that we will discuss later on. Okay, the process. The PPP guide is talking about 5-6 steps. I'm making 5 to simplify here, but this is based on the CP3P guide. Step 1, please produce a raw public sector comparator, so without adjustments. Then turn the raw PSC into an adjusted PSC to permit a fair comparison. So this is adjusting for neutrality purposes, for example, tax neutrality. The taxes as a cost in my payments should not make any difference, because it's money that in either case is going to be back to me as a government. So I should neutralize that, no? And the other most relevant adjustment is for risks. If I want to compare apples to apples, I need to, if I get the costs projected in the PSC and I have the costs projected in the PPP from the government perspective, in the PPP, I am transferring a number of risks, a lot of risk I'm transferring. So I'm paying for that transfer, like an insurance premium, within these payments. But in the PSC, typically, I'm not transferring any significant risk or much lower. So it's not apples to apples. I need to adjust the PSC, the conventional contract, the conventional project procurement projections, by the value of the risks that otherwise I am transferring to the PPP. We will go back to this idea later. Step 3, estimate the cost of the PPP project. Step 4, get a comparable value, discounting, because the two structures, cost structures, streamlines are quite different. Time profiles are quite different. And that can create a lot of distortion or differences in the respective values. You see that from the public perspective, a conventional project, where is the cost concentrated, the payments that I will do? Mostly during construction, no? Because I'm paying directly for the construction of the project. And then a lower payments during O&M. But in the PPP, typically in a very standard PPP with no capital grants, etc., how much I am paying during construction as a public sector, as the government, as the contractual public counterparty? Nothing. During 4 or 5 years, I'm paying nothing. And then, boom, I'm paying much more than in the other case, because when I am paying during operations, I am paying an integrated amount to cover all the loans of the guy, the equity invested, plus the O&M costs. So the time profile is very different and is more back-ended in the PPP, which means that the value is diluted over the time. So it's very important to make it homogeneous, to discount and bring all the projections in net present value. And step 5, I assess, I decide, is this value for money or not, and I report for somebody taking the decision about moving forward or not with the project. Okay, the methodological process in quantitative value for money according to the CP3P guide for an ex-ante value for money, which is basically what we are describing here, before tendering. Okay, produce a raw PSC. We get the base cost projections for the traditional contract, the same that for the PPP contract. So if we are coming from the cost estimates for the commercial feasibility, the cost estimates for the PPP company, I am assessing how much can be the capex for the PPP company. I need to remove the contingencies built in that figure for the risk transfer from the SPV to the contractors, and I need to remove the efficiency gains. So I have a raw PSC base cost, okay? But always under the same technical requirements. So base cost should be the same in the two models. Estimated according to the according to the CP3P guide, estimated in nominal values and including taxes. And we will include revenues from third-party sources and deduct those revenues. The CP3P guide says it could be different. You could use different projections, duly justified. Okay, we will discuss about this later on. Then I need to adjust the PSC. And according to CP3P guide, we have 3 adjustments. 1, fiscal neutrality, competitive neutrality, fiscal neutrality. So we will incorporate in the PSC costs, we will incorporate as an adjustment, adding up a figure that is the tax revenue that I will collect in the PPP, or the difference of the taxes that I will collect from the PPP model, the difference with respect to the taxes that are implicit in my payments in the conventional contract. Because in the PPP, I'm going to make payments to the guy, and within those payments, the guy, private party, has to cover a number of costs. One of them is taxes. Those taxes are bigger than in the conventional contract. Mainly because there is a new agent, which is the SPV. The SPV is not in the conventional contract mode. In the conventional contract mode, the contract is directly with the contractors. But here, I don't have a direct contract with the contractors as a government. I have it with the SPV, the private party. It's the private party who will pay the contractors. So we are having somebody new with their own benefits, and I will ask for a corporate rent. When I am paying this guy, I'm paying also for the tax costs, but that cost is going to come back to me. Okay, so any taxes is going to come back to me in the 2 models, but taxes that I am paying for in the PPP and that will come back are bigger. So I need to neutralize that by adding up that difference, okay? Adding up that difference into the PSC by putting an adjustment. Then an adjustment for non-financial benefits, okay? This is about the higher reliability, potentially, okay, in the PPP, about that the project is going to be in use and generating benefits for the taxpayer, the high reliability that is going to be in the expected time. In other words, we may consider that a conventional contract will have a likely difference in time or a delay, an extra delay of 1 year, in the PSC we will be missing 1 year of benefits for the society. Okay, I need to adjust that. Okay, and then the third adjustment is the risk adjustment. Apples to apples again. Being very simplistic. In the PSC, in the conventional contracts, I am assuming all the risks. But in the PPP, I am transferring a lot of risks. The payments that I'm going to assess to be made to the PPP company are including the value of the risk transfer. I'm paying for that risk. But the payments that I am putting in the raw PSC are not including the value of any risk because I'm not transferring that risk. So I should adjust my costs incorporating the value of the risk that I am transferring in the other model to neutralize that. Okay, this adjustment would be my 600 euros, which is frequency 2 times per year going to the to restore my scratches, multiplied by 300 of new painting every year. That is the value of the risk to me. What is costing me in the PPP projections is only 200, which is the cost of the premium. Definitely in my example, there is a lot of value for money in risk transfer, you see. Okay, listen. The guide says it's okay if you just get the risk that you transfer in the PPP and adjust. But we will see that some countries are incorporating the value of all risks, either retain or transfer. Okay, they are incorporating here. So if you incorporate the value of the retained risks in the PSC, you will need to incorporate it in the PPP as well. Okay, but it's neutral. If I am adding the value of 3, here I am adding the value of 3, it's not creating or destroying value for money. Okay, so for that reason, in the CP3P guide and in many methodologies, you just consider the value of the risk transfer in the PPP in this adjustment. Then let's have the PPP cost estimate. Pure costs, PPP costs are the estimate of the payments that comes from a shadow financial model according to the CP3P guide. But there are other approaches that we will discuss. And then I will do an adjustment according to the CP3P guide, which is the difference of the costs of these two topics, okay? Transaction costs and contract management costs. Okay, in both models, I will have a transaction cost, the cost of preparing the documents, the studies, and so on, and contract management monitoring cost, managing the contract or the project during its life, including oversight with some technical assistance. So the CP3P guide and many general practice all around the world says, this is different. This is more costly in the PPP. So you need to adjust the PPP projections with the difference, an estimate of the difference of the transaction cost. So you don't put it here. You just put here the difference, okay? Some other countries we will see this. They put A and B here, okay? Transaction cost and contract management cost, specific for the estimate specific for conventional contract, and then put here the values of transaction cost and contract management cost specific to the PPP. So they don't need to make an adjustment by the difference. They just put directly the figures. Okay, for the CP3P guide, they go just for an adjustment by differences. Okay, they call it in the CP3P guide the regulatory adjustment. And then discounting. The cost value flows, I mean, the value cash flows in terms of cost, net cost, are discounted in both models using the same rate of discount. Not always it is used in reality the same rate of discount. Particularly in Australia, they may use, depending on the circumstances, different rates. But for the PPP guide, it's typically the same rate of discount. And according to the guide, they don't say good practice or bad practice. They say you can use the risk-free rate or the social time preferred rate Risk-free rate is a financial rate, which is the financial opportunity cost of the government, the cost of the debt for the government, social time preferred rate, and some risk-adjusted rates. Okay, this is pretty much reflecting properly the reality that we will see later on in different countries. And then we assess and report. For the guide, it's a must to do sensitivities. Sensitivities is building uncertainty into the assessment. You have one base case, you have one single number, value for money is positive 10 million, which is 2% of the capex. Okay. But then how about if you change this or this other thing? Because all the estimates are pretty uncertain. So you say, oh, if interest rates goes down to this, the value for money would increase by this. Or if we missed 2% of the costs from the private perspective, when the private is going to assess the capex before they submit the bid, let's say that we were subestimating by 2% that cost, and I put this 2% now, the value for money will be still positive. Wonderful. So sensitivities is to have a framework for the decision. The guide is saying you have to use qualitative analysis to complement the quantitative analysis and integrate it. So you will comment on pros and cons of the PPP, avoiding double counting, things that can be advantages or disadvantages, value creators, value destroyers that have not been captured in the quantitative assessment. Okay, and according to the guide, a positive quantitative value for money is not necessarily mandatory, should not be necessarily mandatory, but only taking, a comprehensive assessment and taking the decision based on the three things. Okay, the base case value for money, sensitivities, and quantitative assessment, which is something that is happening in a number of countries. Okay, forget about this. This is our beautiful checklist for assessing or diagnosing the value for money methodology of a country, looking for what they do or not, and this is the checkpoints that we have established. We may go back to this if we have time during or after the questions. Okay.